Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. My guest today is Mike Downey, Senior Managing Director at Newcleus Credit Union Advisors. Mike has over 29 years experience helping organizations with insurance and investment strategies. And for the last 15 years, his attention and expertise has been focused on helping credit unions retaining and rewarding key executives, in addition to providing institutional investments to help offset employee benefit costs. In today's episode, we're going to talk about collateral assignment split dollar plans and the risks in those plans. In working with credit union executives, the split dollar income stream is looked at like a pension plan. Seems like most credit union executives just look at it like, here's the illustrated series of income payments. They're going to be this dollar amount. They're going to come in at this time, and they're going to come in for this length. We both know those income payments are illustrated, and they may turn out to be better or worse than projected. Mike, tell us about the risks in these split dollar programs and what we should be thinking about and looking for in the design and optimization of split dollar.
Absolutely. Doug, thanks for the opportunity. Yeah, so with the split dollar plan, let's break it down into the three components, if we could. So the first one is the plan design. So the plan design would be, okay, let's talk about vesting. When can the executive actually have true ownership of the policy and access to some of the values? That's one part of the plan design. Another part of the design is, how is the loan? Because these plans are loans to the executive. How is the loan structured? Is it a recourse or non-recourse? And that's important because that determines how the loan may be repaid back to the credit union. And then another part of that loan would be, is it a term loan or a demand loan? Because some of them could be callable by the credit union. So it really depends on how that loan is designed. So I think the first part of looking at risk in a plan design of a loan regime split dollar is the loan structure itself, because not all of them are designed the exact same way.
What's the most common? Is there a dominant form out there?
I would say yes. Earlier on, when these plans were first introduced to credit unions, because where interest rates were at the time, over the last, I would say at least 10 to 12, probably about 10 years now, we see the most predominant design is a term loan, which means that interest rate on that loan is locked in for the life of the loan.
Yep.
And that's because of the IRS table. It's very favorable and has been favorable for a very long time.
Yeah, and I saw a lot of credit unions that already had collateral assignment restructured their plans in the last 24 months to take advantage of that fixed low rate, right, Mike?
Absolutely. And we still see some plans out there that are these early on demand loans without interest charge, which is shocking because they've had an opportunity to basically restructure these loans, refinance these loans. Now, the key there is that ties into the policy itself, meaning we have to look at the policy and how the life insurance policy has performed over that period of time to really align it with restructuring the loan if you have to. Because at the end of the day, that policy is collateral for the loan. But the policy also is providing the benefit, the promised benefit to the executive. So that performance of that policy is extremely important because it's repaying the loan, but also providing a benefit. And depending on the circumstance, that could put a lot of pressure and strain on that particular policy, especially as dividend rates continue to decrease on those whole life policies that are the typical funding source of these split dollar.
Yeah, and in looking at other insurance policies that were put in place 10, 15 years ago, I would often see an illustrated benefit to the person that was far out of whack with reality because interest rates had dropped. Now, in credit unions with collateral assignment, they haven't been around that many years. Most of the time, what, 10 years or less, Mike?
Yeah, I mean, well, I would say we started introducing these in about 2005, 2006. But by the time you go through the education process, credit unions like to know what other credit unions have implemented this. So really, we didn't see that huge kind of increase until, like you said, in the last 10 years because of that process.
So in the last 10 years, interest rates have still come way down. So if your collateral assignment program is built on interest rates, I got to think that your illustration versus your actual reality could be spread there, right?
Well, absolutely. And another thing to add to that is not every provider runs those illustrations the same. Because what I mean by that is you could run it very skinny, very thin, or you could build in a cushion with anticipation that dividend rates could potentially decrease in the future. So that's why that really the third component of a plan, the plan administration and service is so key because every single year that provider should be showing, getting some re-illustrations, enforce illustrations, showing how that policy is actually performing.
Now you need to compare the projections versus the reality and make sure you're on track.
Absolutely. 100%.
Talk to us then. Obviously, we can check in on these illustrations, make sure we're on track, but how do we evaluate risk in the structure of collateral assignment and how do we reduce it?
Yeah, so great question there. We talked about the plan design, how some of the risk can be done there. Another way risk can actually be in these plans is in the plan agreement itself. Not all these plans are written by the same attorney. There's a lot of different law firms and attorneys drafting these plans around the country. So a lot of the language in those particular documents could create risk. And let me give you an example, Doug. There's some language in these documents that gives the credit union and or the board authority to deny a distribution from the policy if they deem that to jeopardize the policy from securing the loan. And this is really overlooked. This is the big one because I don't think a lot of the executives that have these plans realize there could be that probability that a future board could deny a distribution.
The future board can deny a distribution if the distribution is putting the policy at risk.
That's correct. And that depends on how that language is written in that split dollar agreement.
So that definition of what is putting the policy at risk, very important in your plan agreement.
Bingo. Yep.
Interesting. I will attempt to get a law firm on this podcast and we'll dig into that a little bit further.
Okay. Yeah, because that, once again, I think the risk in the loan regime split dollar is, I think the main obvious one we talked about is the policy risk, policy performance. There's also longevity risk because this is a plan that really doesn't end at retirement. It's something that you have ongoing communication between the credit union and the retired executive until that executive passes away. And some people are fortunate to live to age 100. You're talking potentially 35 years post-retirement. So the longevity risk is there. And what's the makeup of the board going to look like and so forth. So there's a lot of what I consider risks that are post-retirement risk. And unfortunately, Doug, if it's not addressed now while they're employed, it's more challenging to address those risks when they're no longer working at the credit.
That's an interesting point, and it brings up a question I've often had when I see a collateral assignment benefit for an executive. They usually end in 20 years or 25 years. The benefit that is illustrated to the executive ends after 20 or 25 years, although the executive's lifespan may continue significantly beyond that. Is there a reason for why they tend to end in that period of time?
Yeah, because most of these are illustrated on the assumption that the executive retires at age 65 and through life expectancy to have access to this money. So a 20-year is pretty typical because it gets them from age 65 to 85. But the plan doesn't end. It just means their ability to take distributions from the policy based off of that projection. They're not forced to take the money. So they have a lot of flexibility if they choose not to take distributions and build up more cash value and take it in the future. But just for initial projections to design the whole plan, 20 years is typically used. Or you get more specific, some providers do the exact mortality age, maybe 81 or 82, and they'll do it for 17 years. But to your point, the reason 20 years is done is just to get them to that 85 range.
Get them to life expectancy. Got it.
But the plan doesn't end. That just means distributions. That plan ends upon the death of the executive. So even though they stop taking distributions, they still own the policy, and the policy still has that collateral assignment, which in layman terms is a lien. It's a lien against the policy. Until that lien is satisfied, they don't have true 100% clear ownership of that policy.
Right. Yeah, there's some risk there to that policy structure. So let's talk about that. Let's talk about what I'm used to seeing in credit union land is a single policy where the credit union picks a provider, and that provider goes out and gets one policy from one insurance company, and that's the entirety of the benefit. So what are the risks in that structure? What are the risks in the different types of insurance? Now, let's not go too deep and get lost in the insurance complexities, but talk to us about what's the safest form, what's the riskiest form, and how do you decide when to use one versus the other?
Yeah, I think let's first address one of the risks, and that would be the credit risk of the carrier. Look at the financial strength of whatever insurance carrier is backing this policy. Now, the majority of that we see out there are A-rated carriers. Very rarely do I see a carrier that is not currently financially strong, but that could always change in the future. So monitoring that ongoing financial strength of the carrier is important. The second thing is the type of policy. Typically, we see two types of policy. One is a whole life policy, and the other is an index universal life policy. Now, the whole life is the more conservative because it's priced with guarantees embedded in it. And because there's guarantees, the insurance company is giving back some of those guarantees that you've paid up front in the form of a dividend. And then a dividend helps, depending how you do it, build cash value and so forth. The index UL is a little bit different because that's based off an index, and the most popular is the S&P 500. But the key here is the money's not in the S&P 500. It's just the crediting rate on that cash value is going to be based off of the S&P 500. So the money really isn't at risk as far as from a market standpoint with the volatility in the S&P. But the crediting rate on that cash value is going to be based off of that performance during a certain period of time. They call it the point-to-point period.
Yeah, I'm used to seeing credit union executives needing to select an index or a basket of indexes on an annual basis. And that, I assume, indicates that the structure is an indexed universal life.
Right. So you asked what's the more riskier, but once it still comes down to how is that initially funded? How is it structured? We would think just off the top of our head that index UL may be the most risky because there could be a period where you have, it's not going to go negative, but you have a zero crediting rate. But if that's structured, Doug, in a manner that's more of you have multiple point-to-point periods. If you dollar cost average up front, that way you have maybe 12 point-to-point periods rather than one.
Okay, Mike, this is news to me. So in one policy, it's possible to have multiple indexing periods, or is that multiple policies?
Yeah. No, multiple index periods. If that is done up front the proper way. So that is one way you minimize what I consider the timing risk of some of these policies. Because imagine if you purchased a policy in March 2019 and March 2020 was your point to point. You had 1 month that was pretty much down last year significantly. So by spreading out that risk and having multiple point to point is one way you mitigate that risk.
Interesting. That is unique to Mike Downey. Thank you for that insight. Now, another thing I want to ask you philosophically, from my standpoint, when we're building a financial plan and we have the collateral assignment income as part of the illustration, my objective is for the person to get what was illustrated. Not trying for upside, not trying to hit a home run on collateral assignment. I'm trying to hit the target, and we'll take some risk in other portions of the person's portfolio. So when I have the S&P 500, just as an option versus a blended approach with some small caps and some international and some bonds, my inclination is if the policy has been illustrated at, let's say, 5 or 6%, I like to take the lower risk option I like to suggest that the executive take the lower risk option, perhaps the middle risk option, because I'm only trying to get the projected return. If we get extra, may not have a big impact, but if we get less, it has a very big impact. What are your thoughts around the selection of the index?
I think it comes down to education as far as if the executive knows that particular index. We have one carrier out there that's a predominant carrier that doesn't give those options. They use one index, they keep it simple. There's other carriers that are going to have maybe 8 different indexes to choose, the Russell 2000 maybe. So the majority of what I see, they keep it simple and they keep it with the S&P 500.
So the S&P 500 is the only choice in the majority of the policy.
With one particular carrier, that's correct.
Okay.
Yeah.
All right.
Yep.
So if you are a credit union and you're looking to say, you've got plenty of collateral, you're going to put this program in place for your executive, and you want the minimum risk. And in your policy design, you want the minimum risk. You can get there one of 2 ways, is what I think I'm hearing, is you can buy a whole life policy where everything is contractually guaranteed, or you could buy a indexed universal life and fund it liberally and sort of create a similar risk environment by the funding design. Is that right?
That's right. But let me just make one small clarification there from a compliance standpoint.
Please.
What I meant by guarantees is, guaranteed, there's no guaranteed distributions, anything like that. What I meant by is that product is priced to endow at a certain age, and it has embedded guarantees there, not taking distributions from the policy. That's not guaranteed. Just wanted to clarify that.
Are the interest rates in whole life guaranteed like they used to be?
Once again, I'm an insurance geek, so I'm going to have to say not necessarily, because by definition, the dividend itself is not guaranteed.
Okay. So even when
if a dividend is paid, then there's some guaranteed interest component in that dividend. But once again, being an insurance geek, doing it 30 years, that dividend is not guaranteed.
Well, that's important to understand, is even the whole life is not fully guaranteed. Everything you see is still an illustration of a dividend rate, and that dividend rate may be greater or less than illustrated. So in both cases, you need to be checking up on these policies every year.
Well, that's correct, because if we look back to why these policies were created 100 plus years ago, was to provide a death benefit, to guarantee a death benefit if a premium was paid. We're not doing that in this scenario. We're looking at more of the cash accumulation and using that for a benefit. So once again, some of those underlying guarantees, I should say, really apply to when you're designing the product to pull cash out, if that makes sense, because they were more death benefit guaranteed than cash value accumulation.
It does. So talk to me about the difference. If you're a credit union and you have a policy already in place for your executive team, and you have a change in your team, or you want to add an additional retention structure, weigh the differences between adding to the existing structure, if that's even an option, versus adding a new policy with the same carrier versus adding a new carrier. Why should I do one versus the other? How should I evaluate those choices?
That's a great question, and this came up yesterday. Actually, there was uh, there was this philosophy that, hey, I have this plan, so I want my other executives to have the exact same thing that I have. Well, you got to take in consideration the age of those other executives. What if they're in their early 40s? Now you're talking about a plan that might be in place for 40, 45, 50 years. And depending on how that's structured, is that going to be a retention or is it really geared towards retirement? So I think each situation, Doug, is, and this is, I guess attorneys say this all the time, it depends. I think that particular situation, we would have to look at the ages of the executives. What is the credit union trying to accomplish? Is it a retention to keep them around until that the CEO retires and more of a succession plan? What's really the purpose of the plan itself? Because then that would determine the best design to use.
So contrast those for me. If I'm looking at a retention plan versus a retirement plan, what path would that tend to lead me down each time?
Yeah, I think then you have to kind of step back and look at the different plans that are available based off of what you're trying to accomplish. Because we're talking about today loan regime split dollar, but there's other plans that might be more suitable for a retention aspect as compared to geared towards retirement.
Tell me more about that. So if we think we want to focus on retention because we've got this 42-year-old superstar running our credit union, talk to me about how we might want to do it differently.
Yeah, could you set up a retention and retirement and everything with one plan like the loan regime split dollar? You could, but is that the most optimal? So you may want to look at, well, what about a 457F plan that might be more suitable to provide those retention, those incremental retention payouts? We call them carrot on a stick for simplicity, but maybe that has a more suitability for those shorter duration benefits than using a vesting schedule in the loan regime that has partial vesting and can get kind of complicated.
Now, Mike, that is really interesting because I've seen many credit union that has a collateral assignment, a single collateral assignment program, and they'll have lump sums come out to the executive at various times, usually when the kids hit to college ages or when various periods of time have passed. It's totally as a golden handcuffs plan. Of course, the executive loves it because when that money comes in, it's tax free and they can take that and do what they please. So contrast that for us, please. The collateral assignment as the golden handcuffs retention plan versus 457F. How do I choose one versus the other?
Yeah, so let's say in that scenario, if they would have used the 457 plan, that executive would receive that same dollar amount, let's say, rather than taking a distribution from their collateral assignment. Because you're taking a distribution from that collateral assignment maybe early. What happens when dividends reduce after that time? What kind of, once again, I use the word pressure, what kind of pressure and stress could that distribution from that policy have in the long term on the back end? Whereas a 457 plan would have just given them that money that they could go ahead and use for college and so forth and leave that split dollar policy intact without any additional strain on it. So I think it really, once again, we have multiple plans available and different designs in the industry that can be used based off of what credit union is trying to accomplish. So with the loan regime split dollar, you could achieve very similar by doing vesting, right? Vesting doesn't necessarily mean a distribution. It just means the percentage of the plan you have at any given time if you decide to leave. So vesting and distributions can be completely different.
Now, that's another interesting point. Let's talk about vesting. So you're a credit union CEO, and let's say you vested 10% a year. What are you vesting in at 10% a year? Are you vesting in an income stream? Are you vesting in a sum of cash, a death benefit? What am I vesting in, and how does that vary across the industry?
I think if you asked an executive that, probably 99.9% of them really don't have any idea. It's very vague. And it really comes down to how that document is drafted, that language in the document. That's a great question. What are you actually vested in? Are you vested in that? Is the policy split into two policies? Is it that future benefit, meaning this plan continues as is, but you only get a percentage on the back end? That's a big question mark, Doug. There's a lot of confusion out
So
there.
is that often
And that's
not even covered by the attorney? It just says you're 10% vested per year, but it doesn't say what specifically you're vested in. You figure that out only if you get into a situation.
I've seen some of these documents. It gets pretty detailed, but it still can get very confusing for the average person. I mean, it's legal language and it's confusing. But that's a good question. That's the $1 million question. What are you exactly vested in? What does that mean for you financially? Do you have access to that money now? What would that look like? Or is it a future access to that money? If I leave the credit union and I'm 20% vested, am I 20% vested in the current cash value? Am I 20% vested in that future benefit? Maybe if I need the money now, how do I get that money now? I'm 20% vested. What does that look like? You're going to give me a reduced paid up policy of 20% of that current value? Well, there's a lot of confusion out there, and that's where I think sometimes to simplify it and optimal, you use multiple plans. You diversify your plan offerings to avoid that kind of confusion. Because if that kind of confusion comes up, guess what happens? You're going to have to get attorneys involved to try to figure out, what am I 20% vested in?
So you might want to make sure that that's very clear in the beginning what you're getting vested in, and that if you end up leaving the credit union for whatever reason, that vested benefit doesn't blow up and become highly undesirable. It's a policy that's still with your old employer where you may not have a great relationship, and now you have to go through them to get the income stream. Is there a way around that? Is there a way around that if you leave the credit union, and this is because you were headhunted away, okay, you leave the credit
Yep.
union for, not on bad terms, but you went somewhere else to run a bigger credit union, and so you've got this 50% vested plan at your old credit union, and I assume what you would have to do is interact with that credit union when it comes time to start getting your benefit. Is there a way, any other way around it?
Yeah. I mean, you could pay off the lien, pay off the note, own the policy outright. And your new employer could do that if you negotiated that coming over, that they satisfy that loan as part of the negotiation of employment. So there are some things you can do to have that ownership 100% outright. Then it comes back to 50% of what? So is it 50% of that current cash value, projected benefit? And that's where, once again, it's oftentimes it depends on that split dollar agreement, how it's written. If it's vague, then it's what exactly is it?
That's why you need both in the executive benefit specialist like you, as well as the attorney. You need a deep specialist in this world that has seen these contracts over and over again to bring up the things that you're not going to think about in the design of the collateral assignment program and the agreement, to make sure that all the stuff that might happen is clear what that means and all parties agree to.
And I think that's extremely important, Doug, because really, if we look at the number of providers that are the predominant providers that do these for credit unions in the industry, I mean, I don't know off the top of my head, I'm going to say maybe six, but they know what they're doing and they know these plans. Where we really see some of these that fall apart is where someone knows an insurance agent and someone knows an attorney, and they try to put these together, and it's really not their area of specialty. So now it's because there's a lot involved, like we talked about. You have the loan, you have the policy, you have the agreement. That is a very highly specialized area. So to your point, it's very important to work with a provider that does this in the space, because they can really help get a plan that's not going to have some of these big complications because of the insurance guy really didn't know this, and the attorney really didn't know how to draft these. And we do see that as one-offs.
Yeah, I've heard nightmare stories about those one-offs, and that sounds like something that is not a good decision.
Because they're not always easy to unwind. So even if they're not done correctly, where is the policy as far as funding? Is it still underwater? Is it above water? Meaning, is their cash value exceed premium? So if to restructure these, if they're not done correctly, is not always that easy. It can be done, but it's not always as simple. So it is important, what you said earlier, to get a lot of this done up front, understand what you're getting into, understand what the potential risks are going to be in the future, and design it and fund it to help mitigate those risks.
Excellent. So earlier in this podcast, we brought up the 457F, which is another SERP structure that is not an insurance policy. It's another form of investment vehicle, and I think there's a significant amount of complexity and interest in the 457F as a vehicle. So we're going to record another episode and really drill in with Mike on the 457F and strengths and weaknesses and funding and different issues there. So thanks again, Mike Downey. We appreciate you greatly.
Anytime. Thanks, Doug.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.